from 99.8% down to 127% up in a single day. This isn't a crypto coin. This isn't a biotech startup. This is the wild, unbelievable story of Beyond Meat, a company left for dead, its stock collapsing to just 50 cents, only to be resurrected by an army of meme stock traders in one of the most dramatic reversals the market has ever seen. How did a vegan burger company become the next GameStop? And more importantly, is this a golden opportunity or the most dangerous trap on Wall Street right now? A world of financial noise. Let's find the signal. Welcome to Smart Money Sense. Today, we are doing a complete financial analysis of BYND stock. We're going beyond the headlines to give you the full, unvarnished truth. We'll break down the catastrophic debt deal that nearly killed the company, the eye-watering financials that reveal a business in crisis, and the meme stock frenzy that brought it back from the dead. By the end of this video, you'll understand exactly what happened and what it means for your money. But before we dive into the chaos of the last 72 hours, we have to go back just 1 week, to a time when Beyond Meat was on the verge of complete collapse. Just days ago, Beyond Meat stock was in a death spiral. On October 16th, it hit an all-time low of 50 cents per share. That's a fall of over 99% from its peak in 2019. The company that was once valued at $14 billion, a Wall Street darling, was now a penny stock on the verge of being delisted from the Nasdaq. So, what happened? It all comes down to a single devastating event: the debt restructuring. On October 14th, Beyond Meat finalized a deal to handle its massive $1.1 billion debt problem. These were convertible notes, a type of debt that can be converted into stock. The company couldn't afford to pay them back. So they offered the bondholders a deal: trade in your $1.1 billion of old debt for about $200 million in new debt, plus 316 million new shares of common stock. Now, that might sound like financial jargon, so let me break down why this was an earthquake for shareholders. Before this deal, Beyond Meat had about 76 million shares in total. By printing 316 million new shares out of thin air, they more than quadrupled the total number of shares. This is called massive dilution. Imagine you own one slice of a pizza cut into 8 pieces. Now, imagine the chef suddenly cuts that same pizza into 32 pieces. Your one slice is now tiny, and its value has been diluted. That's exactly what happened to anyone holding BYND stock. Existing shareholders went from owning the whole company to owning less than 20% of it overnight. The bondholders, who were once lenders, effectively became the new owners. The market's reaction was brutal and immediate. The stock crashed 48% on October 13th, another 24% on the 14th, and another 22% on the 16th. It was a complete and utter bloodbath. Analysts and institutional investors, the so-called smart money, fled for the exits. TD Cowen slashed their price target to just 80 cents. The consensus on Wall Street was clear: Beyond Meat was toxic. The company had saved itself from immediate bankruptcy, but it had done so by sacrificing its shareholders at the altar of debt. This is a critical moment in our analysis. If you're finding this breakdown valuable, take a second to hit that like button. It tells the YouTube algorithm that this is the kind of in-depth financial content you want to see, and it helps our channel bring these deep dives to more people. There's so much more to uncover. Now that we understand the event that triggered the collapse, let's look under the hood at the company's financials. Because the debt deal wasn't the cause of Beyond Meat's problems, it was a symptom of a much deeper crisis. The numbers for Beyond Meat paint a bleak picture. Their latest quarterly report for the second quarter of 2025 was a disaster. Let's start with revenue. Revenue came in at just under $75 million. That might sound like a lot, but it was down almost 20% from the same quarter last year. And it missed analyst expectations by a wide margin. Sales are not just slowing down, they are actively declining at a terrifying rate. U.S. retail sales crashed by 26%, and even international food service, once a bright spot, plummeted by 25%. People are buying less Beyond Meat, period. But it gets worse when we look at profitability. Out of that $75 million in revenue, their gross profit was only $8.5 million. That's a gross margin of about 11%. For comparison, a healthy food company often has margins of 30 to 40%. But Beyond Meat's cost to produce its products are so high that it barely makes any money on what it sells. And we haven't even gotten to their operating expenses yet, things like marketing, research, and salaries. After paying for all of that, their operating income was negative $34.9 million, and their final net loss for the quarter was over $33 million. Let me put that in simple terms. For every dollar of product Beyond Meat sold, they lost about 44 cents. This is not a sustainable business model. Now, let's turn to the balance sheet. As of the end of June, the company had about $103 million in cash. But their free cash flow, the amount of cash they are actually burning through, was negative $35 million in that quarter alone. If you do the math at that burn rate, they had less than 3/4 of cash left. That's around 8 to 9 months before the bank account hits zero. This is why they were so desperate to do that debt deal. They were running out of time and money. Their total debt was a staggering $1.28 billion, while their total stockholders' equity was negative $680 million. When your equity is negative, it means your liabilities are greater than your assets. On paper, the company was insolvent. So, to summarize the financial state of Beyond Meat stock before the meme frenzy: declining sales, terrible profit margins, massive losses, a dangerously high cash burn rate, and a balance sheet teetering on the edge of bankruptcy. From a fundamental investing perspective, this was one of the riskiest stocks in the entire market. And it was this exact combination of financial despair and overwhelming negativity that created the perfect storm for what happened next. On October 17th, with the stock trading for pennies and Wall Street declaring it dead, something incredible began to happen. The stock jumped 24%. Then, on October 20th, it exploded. It rocketed up 127% in a single day on trading volume of 1.2 billion shares. To put that in perspective, its normal daily volume is around 20 million shares. This was an increase of 6,000%. The stock became the #1 most discussed name on Reddit's WallStreetBets, the infamous forum behind the GameStop saga. This was a classic, textbook short squeeze, fueled by a new wave of retail investors. Here's how it works. When a stock is doing terribly, like Beyond Meat was, many large hedge funds short the stock. This means they borrow shares and sell them, hoping to buy them back later at a lower price and pocket the difference. It's a bet that the stock will go down. By mid-October, the short interest in BYND stock was astronomical. Almost 63% of the company's publicly available shares were sold short. This is an extremely high number, and it means the trade was very crowded. This created a coiled spring. All it needed was a catalyst to set it off. Enter a Dubai-based retail trader posting under the name Capybara Stocks. Immediately after the debt deal crashed the stock, he bought 3.1 million shares at around 78 cents each. He then took to social media, including Reddit and YouTube, with a bold thesis. Wall Street had misinterpreted the debt deal. He argued that by eliminating the near-term bankruptcy risk and slashing its debt, Beyond Meat was actually in a stronger position. This counter-narrative was exactly what the retail trading community was looking for. The idea that the smart money was wrong and that a heavily shorted stock was actually a coiled spring ready to explode is the lifeblood of the meme stock movement. Thousands of small investors piled in. They weren't buying because of price-to-earnings ratios or discounted cash flow models. They were buying to fight the hedge funds. They were buying to be part of a movement. They were buying to force the short sellers to buy back their shares at a massive loss. As the price started to rise, the short sellers began to panic. To close their positions, they had to buy back the shares they had borrowed. But all this buying just pushed the price up even higher, which forced more short sellers to buy, creating a vicious feedback loop. This is the squeeze. The result was the parabolic move we saw on October 20th. It had almost nothing to do with the fundamental value of Beyond Meat as a business, and everything to do with market mechanics, social media hype, and a rebellion against institutional investors. The BYND stock narrative had been completely rewritten, not by the company, but by the crowd. So, what do you think about this phenomenon? Is this the democratization of finance, or is it just reckless gambling? Let me know your thoughts in the comments below. I read every single one, and I'm genuinely curious to hear your perspective on the rise of the retail trader. Now, with the stock price completely detached from reality, we have to ask the most important question of all. What happens next? To understand the future of Beyond Meat stock, we have to look at two separate things: the struggling business and the unpredictable meme stock. First, the business. The entire plant-based meat industry is facing a crisis of consumer confidence. Sales are declining across the board. Customers are complaining about high prices, long ingredient lists, and a taste that still doesn't quite match the real thing. Many are turning back to conventional meat or choosing whole foods like beans and lentils instead of processed meat alternatives. Beyond Meat's management knows this. Their new strategy, announced in mid-2025, is to pivot away from mimicking meat. They even plan to drop meat from their brand name. They just launched a new product line called Beyond Ground, which has a much simpler, cleaner ingredient list, only 4 ingredients, and boasts 27 grams of protein. The idea is to compete in the broader $100 billion protein market, not just the niche vegan market. CEO Ethan Brown is essentially trying to reboot the entire company and its public perception. They've also brought in a chief transformation officer from a restructuring firm to slash costs, lay off more employees, and try to steer the company toward profitability by 2026. This is a race against time. Can they reinvent their products and fix their cost structure before they burn through the cash they have left? The success of this turnaround is far from guaranteed. Then you have the stock itself. Meme stock rallies are notoriously volatile and short-lived. The price is no longer driven by fundamentals, but by social media sentiment and the ongoing battle between retail bulls and institutional bears. The high short interest of 63% remains, which means another squeeze is possible. But these events are unpredictable. History shows that after the initial squeeze, most meme stocks eventually crash back down to a price that reflects their underlying business fundamentals. For every person who makes a fortune timing the rally, many more are left holding the bag when the music stops. So, what's the final verdict? Is BYND stock a buy, sell, or hold after this insane volatility? My analysis is this. As a long-term investment, Beyond Meat remains an exceptionally risky proposition. The company is facing severe fundamental challenges in a declining industry. The path to profitability is long and uncertain, and the massive shareholder dilution from the debt deal will act as a permanent anchor on the stock price. Even if the company survives, the per-share value has been fundamentally reset to a much lower level. As a short-term trade, it's a pure gamble on momentum. Trying to time the peaks and troughs of a meme stock squeeze is more akin to playing at a casino than investing. The potential for huge gains comes with the equal potential for catastrophic losses. The story of BYND stock is a fascinating case study in modern finance, where narratives can overpower numbers, and a crowd of online traders can challenge the giants of Wall Street. It's a stark reminder that the market isn't always rational. But for those of us focused on building long-term wealth, the principles of sound financial analysis remain the most reliable guide. The noise is temporary. The fundamentals are what last. Now you have a clearer picture of the chaos surrounding Beyond Meat stock. But I want to know what you think. Leave a comment below with your biggest question or takeaway from this analysis. And if you're ready for the next topic in our deep dive series, click the video on the screen right now. If you believe in making finance make sense, join our community by subscribing so you never miss an insight. This is Smart Money Sense. Keep building your sense.